You check your Shopify revenue on a daily basis, but do you know your daily profit? Do you know your daily contribution margin? And are you measuring your incrementality as you try and scale your business? Come do day over day incrementality with me. Here's an example client where we look at the last 3 days of incrementality. Incrementality is the concept of scaling profitably incrementally. So as we push, as we try and scale, are we adding additional profit contribution margin at the bottom as we push up, or are we losing money as we scale? Are those additional dollars making us additional revenue and profit, aka contribution margin, or is it just going into the black meta hole? Let's look at the last 3 days for this client. You can see spend has varied over the past 7 days, ranging from $2,000 to $1,200. But recently we have a higher blended ROAS. So this is just in platform ROAS blended together from all of our major platforms, in this case, Bing, Meta, and Google. So we see an average of 4.5 to 5.5. Then we look at our total spend by day and our gross revenue. Finally, here are our efficiency metrics. So how many new customers are we gaining each day? What is our net revenue? And then what are we acquiring each customer at? So our customer acquisition cost, ranging from $40 a customer to $20 a customer. Here we have our aMER. So all of our net new customer revenue, only net new customer revenue, divided by all of our media spend. So this ensures that at the very least, forget existing customers or customers coming back for promos and sales, or existing customers that we're emailing. How many net new customers are we bringing in over all of our media spend? This will tell us if at bare minimum, how much we're covering our expenses with net new customer revenue. This is a super important metric. You can see this is around 3 to 4x over the past 3 days. And finally, and most importantly, we see our contribution margin. So after all expenses, variable costs to fulfill the product, ship the product, COGS, and our marketing spend, what is our contribution margin left at the end of the day? How much profit are we adding into the business, ranging from 5K to 3K? Okay, now let's do a quick analysis. High level, why are these in orange if they are higher numbers? Because over the past 90 days, these metrics tell us to scale harder, to scale faster, that we can push up. Meaning, contrary to popular belief, at a certain point, our ROAS is too high, meaning there is room to scale. There's room to push this spend up, which if we hold these CACs and these aMERs will yield additional gross revenue, additional net new customers, incremental net new customers, thus pushing our contribution margin up. So we will be pushing spend up, pushing contribution margin up as our ROAS comes down. Why? Because as you push, as you scale, at some point your ROAS will come down. But we know for this client, and this is why we have this in green, that our break-even ROAS is in the 3 to 4 area. In fact, we have this set at a 3.5x specifically. So we know when we're in this range, if we are acquiring customers at a healthy rate and we're not in a promo sale period, which we are not right now in the last 3 days, that these are go signals. So instead of going backwards for the last 2 days, this is a reverse signal. And we actually have automatic signals coming to our media team to push back up and to scale up. So as long as we see contribution margin going the right direction. So as we push and scale back up to 2,000 a day or beyond, if and as we see contribution margin going up, then we are good to go. Because if this goes up, this means our new customers are going up, our net revenue and gross revenue are going up, and thus our future growth of the business and our current new customers are all growing at the same time. For fun, we can also see a detailed version. For simplicity's sake, let's take Bing off and just look at Meta and Google. So the same information we can see here, just broken down by Meta and Google, so that we're not just looking at a blended ROAS. So we see a blended ROAS of 5.6. What makes that up? Well, this is the Meta reported in-platform ROAS of 4.2, blended with our Google Ads reported in-platform ROAS of 7, equaling our blended ROAS of 5.6. We can also see what we're spending on each platform and what we're reporting back from each platform for in-platform revenue contribution. So this helps us look at a more granular level before we then pivot over to the in-platform metrics and final decisions. If your media team, in-house team, agency, yourself, whoever it is doing the media buying, if they don't have these signals and understand these signals and buy off of these signals, you are leaving money on the table. In one day, you're probably burning too much money. In another day, you're leaving profitable revenue growth on the table. And you're doing this hoping that your monthly forecasts are perfect and your monthly set budgets are randomly the perfect amount, when, as you can see, that is not the case. If you open any account and look at incrementality and look at a day over day, new customer count, CACs, contribution margin, ROAS, there are so many variables that influence these numbers. So be sure that you can measure your daily incrementality and contribution margin. You can do this with Profit Compass. We offer this free to e-commerce owners and operators. It's a tool that we use with every single client engagement, but we also offer it for free. We can do a free analysis, get all of your real-time data in here, show you your issues and opportunities, where you're winning, where you're losing, and what you decide to do with it from there is up to you, or you can work with us.